So the console cash flow is just like normal cash flow, and all cash flow statements are just like you are preparing your cash book. Okay, you want to know the cash activities that uh, took place within the year under the review. So you'll be looking at cash that you are getting, cash that you are spending under operating activities, cash that you are getting and also spending under investing activities, and also cash that you are generating or you are spending under financing activities. So it's just like a normal cash flow. And we use the indirect method. Cash flow, uh, determine the cash flow, we use direct and indirect method. So, but this one you'll be examined based on the indirect method. The direct method is where you use your cash received from debtors, cash paid to your suppliers. You subtract your cash expenses, your cash received from operating activities and other issues. So, but this one, they will give you the indirect one where you'll be starting with profit. You know that profit is ascertained using accrual basis. So there are certain non-cash items that are included in determining your what? Your profit. So you have to now adjust your profit with those non-cash items to get your cash items. So determine your profit, you are going to be taking depreciation, you are going to be taking impairments, you are going to be adding profit on disposal of assets. All these things are non-cash items. So you have to adjust them. You have to add them back to your profit to have your cash flow. You're also going to be having issues from debtors. Okay, so we also look at the impact of the debtors figure on our cash flow. Okay, so let's assume that we have a cash receipt. Okay, we have a cash receipt of, okay, we have a cash receipt of 200,000. Okay, cash receipt from debtors. But our opening debtors figure, was 40,000. And our closing debtors figure was say 50,000. Okay, since we are using profits, okay, we are going to be starting with profit. We are using indirect method. Okay, the actual cash received for the year that should be entered in the cash book is what? Is 200,000. But we didn't use the cash receipt before getting the profit. We use sales. Okay, we use revenue. So what figure are we going to be using as revenue for the year? If this is the information that you have cash receipts, you have opening debtors, you have closing debtors. What will be the revenue? What will be your revenue for the year? What will be your revenue for the year? What figure are you going to be reporting as revenue?
Is it 210?
150.
No, revenue for the year. Okay. You are no. Okay, you are owing me 40,000 and you have paid 160,000. Okay, I will take the 40,000 out of it. It means that I have sold goods to you 160 for this particular year. That's why you are paying me 200,000, but you are still owing me 50,000. It means that the total goods sold to you for this year is 210,000. The 200,000 that you are giving to me, I will take the last year owings from it. I will be left with 160, which will be the item that I will be selling to you for 160 now. But you are still owing me 50,000. It means that I have sold to you 210 type of goods. This is just like you just do like your control accounts. You have your opening balance, your cash receipt, and your closing balance will be on the credit side. So the credit sales for the year will be 210. Okay. So if you are preparing your statement of profit or loss, you are going to be using a revenue of 210. Okay. But we are looking for cash. We are doing cash flow. The actual figure that should have been used should have been 200,000. That is the cash that we received. But you use 210 in preparing your statement of profit or loss. But we are looking for only the cash that we receive from the revenue, the cash that we receive from the debtors for the year, which is supposed to be 210, but you are using, which is supposed to be 200,000. You are using 210. It means that what? You have what? Overstated your cash receipts in the profits by 10,000. That is what we look at the what? The changes in working capital, and we see, okay, closing balance is higher than this one. No, it's not that you are selling, you are using more cash to buy goods and sell it to what? The debtors. No, we are looking at the impact of the closing balance or the changes on our profits. The changes of the 110 over here has increased our cash receipt by 10,000 because the cash receipt should have been 200,000, but it has now what? 10,000. 210,000. So it means that the change in revenue, which is changes in working capital, we now have debtors, which will be increase in debtors. Okay. So increase in debtors. So if the debtors figure is increasing, what is the impact of that? That is increasing our revenue. We are looking for only cash portion, cash received from the debtors. But we are using accrual basis. So we include both cash and credits. So we are using 210 for the revenue. So included in the profit that we are using, there's a revenue of 210, which should have been a cash receipt of 200,000. So what we do is that the increase in the debtors will now be treated as what? As an outflow. Why? Because the increase has increased our cash received by 10,000, which is the revenue that we have as 210. The same thing applies to the purchases. The inventory is supposed not to go into the cash flow statement or the cash book, because if you purchase inventory, it will be treated as purchases, and you have paid that particular amount to creditors already. So inventory is supposed not to come into the cash flow. But when you treat the inventory is either going to increasing your cash or reducing your cash. All right, let me use figures here. Okay, assuming so let's come here. We have, so let me start with the same one here. So let's say that purchases is the same. Okay. Okay. So let's say that purchases is the same for this. So purchases, there is no opening balance for creditors, and there's no closing balance. So the cash purchases, there is no opening, there is no closing. So cash purchases is, let's say the cash purchases is 150,000. Okay. In the cash book, this is how we are going to record this now. Okay. We are going to be having cash receipt from debtors, cash receipt from the debtors. So cash book, we are going to be having cash purchases of 150,000, and we have the sales or the cash receipt of 200,000. We'll be having a balance of 50,000. So this is how we are going to record our sales and our receipts and our payment for the year. We are going to be having a difference of 50,000. So we received 200,000. We made a cash purchases of 50,000. So our cash balance is supposed to be 50,000. But since we are using accrual basis, in our profit or loss, we are going to be having a revenue a revenue of 210. Okay. So let's assume that we have opening stock and closing stock. So opening stock, let's say opening stock is 20,000. Closing stock is 30,000. Okay. So we have our cost of sales. We have our cost of sales to be opening stock will be, so that would be 140,000. So our cost of sales will be 140,000. Okay. Then we now have a profit of 60,000. Okay. So we add the opening stock and subtract the closing stock. So that will be 140,000. We are having a profit of 60,000. But our cash figure should have been 50,000, which is the net cash that we have spent from the sales and then the purchases. But we are starting with a profit of 60,000. Once we know that the receipt and then the cash payment is 200 and 150 respectively. So our cash balance is supposed to be 50,000. But we are now having 60,000. What is increasing the 50,000 by the 10,000 to make it now 60,000? What is increasing? What is bringing the 10,000 increase? What is bringing the 10,000 increase?
So I think as we've done earlier, the 10,000 was coming from the increase in the debt.
No, not debtors. We are using stock now, opening stock and closing stock.
But we still use 210,000.
Yeah,
I think the difference is coming from the increase in our stock.
in our stock, isn't it?
So increase in the
Yes.
closing stock.
Okay. So the increase is coming from two sides, stock and the okay, this is supposed to be 200,000. Sorry, let me just use 200,000 here. So if I use 210, that will be 70,000. So 200,000 there. So we are using a receipt. Okay, but the issue now is about the stock. Okay. So you can see that the stock is the one bringing the 10,000. The stock is already included in the purchases. Okay. We purchased the goods, we paid for it, but it's just that we are not able to use it. We are not able to use all of them. It means that the cash paid for the stock is already captured in the purchases. But since we are preparing profit or loss and we are using the accrual basis, we are still capturing the stock over there. Okay. So this stock, if the opening stock and the closing stock should be 2020, there will not be any effects. But you can see that the stock, we supposed not to go to the cash statement itself. It is now increasing our figure by what? By 10,000. Why? Because the closing stock is higher than the what? The opening stock. So we find a change in the what? In the stock, which will be the opening against the what? The closing. So you can see that our stock has increased by 10,000. If a closing stock is increasing, what is the effects on our what? On our profits? It is going to be increasing our profits. So since it's going to be increasing our profit, it means that it is going to be increasing our cash flow too. The cash that we are using over here is 60, but should have been 50. So what is the effect of increase in the stock on our cash? It's going to be increasing the cash, which does not form cash component. So we bring the changes in the stock over here as an outflow because that has increased our profit by 10,000. So we come and subtract it 10,000 and we have our 50,000 as the cash for the operating activities. It is not that we are spending more money to purchase stock, so cash is going out. No, it is the effect of this particular stock on our cash flow. It has increased our cash value by 10,000 because we are using profit. The cash should have been 50,000. The closing stock has now increased it by 50,000 because a higher closing stock is going to be increasing our profit. So that difference should be taken away from the profit to to represent the cash component, which is the 50,000. The same thing for our opening stock. If the opening stock is higher, it is going to be reducing our profits. In other words, it is reducing our cash. So what do? We go and add it now to have our normal cash for the year. The same thing applies to the purchases. So it's not that you are spending more money to buy stock, or you are spending you are paying part of your purchase, your creditors. No. It is the impact of the difference over there on our cash flow for the year, not we are spending more money to buy stock, or we are doing anything. So if you should have that particular assumption that, oh, more cash is coming in, we are receiving some money from our debtors. No, it is the impact of the increase in the debtors on our revenue figure that we are using in the statement of profit or loss. All right, our cash flow statement is just like any other cash flow statement. We will be having the operating expense, operating activities rather. So operating activities rather, we are using indirect method. We start for consolidated cash flow statement. We start with profit after share of associate profits. So you start with profit after share of associate profits. Okay. Profit after share of associate profits. Okay. Then you'll be having a finance cost, and this finance cost, there can be a credit element in it. Mostly we calculate our finance cost using the effective interest rate, which is calculated in accordance with IFRS 9. So it might happen that the coupon, we are only interested in the coupon. We are only interested in the cash component for the finance interest. So we add a finance cost back, and now come and look at what is the amount that we have paid. What is the cash paid for the interest? The one over there can be the actual cash paid, or it can be the cash plus the owings, which we always calculate using the effective interest rate. So you add a finance cost back. Okay, you are also going to be having non-cash items like depreciation, those depreciation and profit on disposal. All these figures are reducing and increasing our profit, but these are not cash items. So if you have a cash of 50,000 and you depreciated the asset by 10,000, you are going to be having 40,000, which is not a cash. So add your depreciation back to it to have your 50,000 as a cash. Profit on disposal is going to be increasing your cash, but this is not a cash item. You have to go and subtract it back. So you also subtract a share of associate profit. It's just a profit, not cash. So we capture the dividend that we are receiving from the associate under investing activities. So it's just a normal cash flow items, changes in working capital items. You come to investing activities. Investing activities, what are the activities happening during the year? The parent is going to be buying the net asset or shares in the subsidiary. That is an investment. So how much is the parent paying? And how much is the parent having from the subsidiary in form of cash? So the parent might be paying 200 million, and included in the net asset of the subsidiary, we are going to be having a cash of 50 million. So in effect, the parent is spending 200 million and getting a cash of 50 million. So the purchase consideration, which will be under investing activities, we net it against the cash that we are receiving from the subsidiary. Okay, so we'll be having 150 there. Other investing activities like acquisition of fixed asset, disposal of fixed asset, other items, you have to bring them there. Financing activities to dividend paid to the NCI, dividend paid by the parent company, shares that the issue of new shares, redemption of loan, all those things will come under the what? Under the financing activities. So we are not here to look at formats. You can have other items. You just have to ask yourself, what is the impact of this on our cash flow? Okay, we are just preparing cash book. It's just a cash book that we are preparing. So what are the cash items that will go there? That is what we are doing. But the basic thing is that how do you determine your items, especially if you come to your changes in working capital items? How do you changes in working capital items? How do you identify the changes and how do you go about it? So we are going to be using inventory. We are going to be using inventory. We are going to be using receivables. And we are going to be using payables. Okay. So what we do is that they will give you the statement. The statement means they have done the right thing. The parent has done every necessary entry before they will be having their statement. So they will give you 2-year statement. Okay. So you look at what is the inventory value. So the parents might be acquiring a new subsidiary within the year, or the parents might be selling off, might be disposing a new subsidiary during the year. Okay. What we have to know is that the subsidiary that we are disposing during the year, its net asset items or working capital items are included in the opening figures of the asset liabilities and all those ones. So you ask yourself, what is the parent opening inventory, which will be the previous year? The question will give you that. So you bring the inventory there. Let's assume that the parent is having an inventory of 20,000. Okay, you bring the inventory there. Okay, the parent has now acquired a new subsidiary with an inventory of 10,000. So what's supposed to be the inventory in the consolidated financial statement at the end of the year? If we are consolidating, what will be the total inventory? Assuming there is no intra-group trading, what will be the total inventory at the end of the year?
30,000.
That will be 30,000. Okay. So what you do is that you come and do the correct thing. So the inventory figures, you look for the supposed figures. Okay. The inventory figure should have been the parent figure of 20,000 plus the subsidiary's own, which is acquisition. So you add it to now have the supposed figure of 30,000. Okay. Then you compare this with your what? With your closing balance in the statement of financial position. So they can give you maybe 40,000, which will be the closing balance. So it means that there is an increase in the inventory of 10,000. So this increase over here has increased our cash. So we go and subtract it as increase in what? Inventory. So you look for the supposed figures. The parent is having this figure. The parent has acquired this subsidiary. So what's supposed to be our inventory figure? So it's supposed to be the parent own plus what? The subsidiary's own. Is there any disposal of a subsidiary that will be taken away from our inventory? So we look for the supposed inventory figure. Then we take any disposal of a subsidiary, we take their figures out of it. Then we compare with the closing balance. So you just look for the increase or decrease and you know how to go about it. That's how we normally look for the working capital items. So you look for what is the consolidated, what's supposed to be the consolidated what figures. What is the figures that is given to us in the closing or in the recent financial statement at the end of the year, compare. So the same thing for the receivables. You look for their supposed figures and compare with what the actual figures. If you come to PPE2, the question will be giving you depreciation, or the question will be giving you the asset purchase for the year. So either they will ask you to look for the depreciation figure, or they will ask you to look for the what? The asset purchase during the year. How do we go about this also? You look at, so let's come to the PP. How do we find the investment in PP, the acquisition? You look at the parent figure. Okay. So let's say the parent figure is 20,000. Okay. So you look at the parent has acquired a new subsidiary. We are going to be adding, definitely we are going to be adding that figure to the parent figure if you are consolidating. So let's say that is 15,000. Okay. If there is a depreciation is going to be reducing our figure here. So let's say depreciation is 5,000. Okay. If there's a revaluation is going to be increasing our asset 2,000. Okay. If there's a disposal of an asset, the disposal will be done at a carrying value. And this is also, since we are selling the asset, disposal will be reducing our assets also. So let's say there was a disposal of 10,000. So these are the things that are likely to be increasing or reducing your assets. Then you look for your closing balance. You look for your closing balance. So maybe 20,000 plus 15, that will give us 30 plus this will give us 32. This will give us 22,000. This is supposed to be our consolidated what PPE, but they can give you a closing balance of 38,000. It means that there was an addition. You have purchased this one for 16,000 during the year. So this will be the acquisition of your PPE during the year. So you just have to reconcile the items. Okay. So it's all about reconciliation of the item. You also go to the investment in associates. How do we account for investment in associates? We have the investment in associates. We account for it as investments in associates. We account for this as, okay, how much are we paying for them? So we have the purchase consideration to be this figure. We add our share of profit. Okay. So if we add a share of profit, if there's no dividend, this is supposed to be the closing balance. Then you now compare with what? The investment in associates at the reporting date. What is the difference? Any difference over there will be taken as a dividend received from the what? From the associate. That will be captured under investing activities. Or the difference can be an impairment. If it is an impairment, they will state it. If nothing is being said, the difference between that will give us our dividend that we receive from our associate. You do the same thing. You do reconciliation for the retained earnings. What's supposed to be the retained earnings at the end of the year? How do we get a group retained earnings? We pick the parent figure. We add the share of the parent profits, any adjustment. They have done all the necessary adjustments. Any difference between that will be seen as a dividend paid by the what? By the parent company. That will be captured under financing activities. You have to also reconcile your debt figures. Every figure over there must be reconciled for you to know the cash that has been spent on that particular item for the year. That's how we do that. It's always all about reconciliation. Reconcile all the items there. Do it the way we have been doing it. If you are preparing group accounts, how do we treat these transactions? They have done that already. So you just have to look for that and, okay, what is the cash paid? You have to do the reconciliation for the NCR also. You pick the NCR at the beginning of the year. If there's any acquisition of a new subsidiary, that will be increasing our NCI. NCI share of the profit will increase the NCI. Okay, so you now look for the supposed NCI, compare with the closing balance. What is the difference there? The difference over there is a dividend that has been paid to the NCI. That will also be treated as an outflow under financing activities. So it's all about reconciliation, and that is it. So let's try to pick tutorial questions so that we can do the reconciliation proper. Okay. So let's look at the question here. Okay, let's move from simple to complex. Question number 3. Okay. So with the question number 3, one thing that you have to do is that you are going to be using the indirect method. So just come. What is our profit before tax? We always use profit after the share of the associate profit. So what is the profit there? Let's go to what is the name of the company? FB Group. So we have the consolidated cash flow statement. Okay. So consolidated cash flow statement for the year ended. So you can do your year ended and those ones there. So let's have our currency here. Let's have our currency here. So you just have your operating activities here, cash flow from operating activities. Operating activities are our normal business activities. Okay. So we have our profit before tax. Okay. Our profit before tax of how much? How much is that? Question number 3. Do you have the question? If you don't have, let me share. With you people in the All right. So what is our profit before tax or the profit immediately after the share of associate profits? How much is that?
Sir,
9,200.
Okay.
sir,
We have 9,000.
sir.
Yes, please.
Does it mean that because there's no profit after the share of associate profit, that's why we are taking profit before tax? But if there should be a profit after the associate profit, then we take that one.
This the profit before tax is the profit after the associate profit. We have associate profit of 2,900.
Oh, okay. Let me.
Okay. So what do you do? The associate profit, is it cash that you are receiving? No, it's just a profit. So you now bring your add or your subtract. Okay. So you bring your add or you subtract. Then you have the share of associate profits. The share of associate profit is not cash. The only thing that you are going to be receiving from the associate is dividend, which will be the cash. So that will be a subtraction because that has been added to our profits, which is 2,900. So you subtract the 2,900. Our finance cost. We want to know the actual cash. Yeah.
You say add share of associate profit and you are subtracting it.
Add or subtract. Okay. So those that you'll be adding, you add. Those that you'll be subtracting, you subtract. Okay. Or let me just put non-cash items there. So it should be add or subtract. Okay. So let's just forget about the add. Let's just bring the items like that. So forget the add. So share of associate profits. So let's have this one as a subtraction. Our finance cost. Finance cost is how much?
$1,900.
So that will be added. We want to know our actual cash that we are paying. So you can go to the footnote and look for depreciation. Okay. Okay, the depreciation charge for the year is what?
$4 million.
So you can look for your depreciation. So we have our depreciation, which is a non-cash item, will be added as 4,000. Okay. So you now look for other items that will be coming. We can also have impairment over there. So maybe you can leave a space for impairment. Maybe there can be a profit on disposal, but this one said that there were no disposal of property, plant, and equipment in the year. So there's no disposal on that particular item. So let's leave Let's leave some space over here. Then we come to, so you can just move on to investing activities by leaving a space over there for other necessary things that will be coming. So the investing activities, okay, the investing activities is you have to look for the investment in the subsidiary. Okay, if you are purchasing a subsidiary, that will be seen, or that is an investing activities. Okay, so we can come to the B side over here, which is an investment in a subsidiary. We are acquiring a subsidiary. So just read this particular one and let's move on. So let's look at the B part. Auntie Agnes, are you there?
Yes, please.
Okay.
B. FB acquired a controlling interest in SM during the year for 6,350,000 Ghana cedis. The consideration consisted of 350 Ghana cedis in cash and the transfer of 4 million of FB's equity shares with a deemed value of 150 pesos per share at the acquisition date. The non-controlling interest was measured at its fair value of 450 Ghana cedis, 450,000 Ghana cedis at the acquisition date. FB made no other purchase or sales of the investment in the year and had no investment at the start of the year.
Okay, so we are buying a subsidiary for a value of what? 6,350. Okay, but what is the cash component of this amount? How much did we pay as cash?
350.
So you only pick the 350. Okay, it was share exchange. Share exchange, we are not paying any cash. So you just come here and have acquisition of a subsidiary. So acquisition of a subsidiary, that will be 350. So if you are receiving any cash from a subsidiary, in terms of the net asset, that will be net against our 350 there. So let's take the C.
C. The fair value of the net assets of SM as at the acquisition date were as follows: property, plant and equipment 2,400, inventories 3,600, receivables 2,000, cash and cash equivalents 200, payables 3,800.
So it means that the cash that we are receiving from them is 200, isn't it? Okay. So that
Yes.
the net amount that we are spending is 150. So you just bring the 150 over here as an outflow. Okay. As soon as they have given you this information, you can go ahead to calculate any goodwill. So they are talking about impairment of a goodwill. So you can go ahead to calculate a goodwill on acquisition of the SM. They have been acquired during the year. So let's come here and have our financing activities over here so that we can now use the remaining place for workings. Okay. So let's come to, let me see. Okay. So let's come to our workings here. I'm sure this place will be enough. So let's come to workings here. Okay. So the workings, let's come to, please, good structure is not needed for consolidated cash flow because they have done all those things already. Okay. We are just looking for the cash for the group. So the workings one, let's make the workings one to be goodwill. Okay. Goodwill calculation so that you can also reconcile the goodwill figure to know whether there is an impairment or there is no impairment. So let's come to the purchase consideration. What is the purchase consideration? That was 6,350, isn't it? Okay. So we add the NCI to it. What is the NCI figure? All these figures will be given to you. What is the NCI figure?
450. 450.
Okay. So NCI will be 450. Okay. So the total will be 6,800. Is that correct? Okay. What is the net asset at acquisition? They have given you the net asset at acquisition already. What is the fair value of the net asset at acquisition? Total.
4,400.
Okay. 4,400. So 4,400. What will be our goodwill?
$1,400.
2,400. All right. Okay. So go to your statement of financial position now. This acquisition has been done during the year. So it means that if it is during the year, it will be under the 2020. So this transaction happened during 2020. What was our goodwill figure in 2019? Was there any goodwill
2,400.
figure? No, for 2019.
In 2019, there's none.
There's no goodwill, isn't it?
No.
Okay. But right now, what is the goodwill figure at the reporting date now?
2,000.
But the actual goodwill should have been how much?
2,400.
So what is happening there?
There's a loss in goodwill. That's impairment.
Okay, so the goodwill has impaired by 400. Okay, and this was stated over here. And an impairment review conducted at 31 December resulted in the goodwill being written down and amount being charged to profit before what? Tax. So there is an impairment of goodwill, and that has been charged to our statement of profit or loss, which is a non-cash item. So you have impairment of goodwill here that will be added as 400. Okay, so we have reconciled the goodwill already. We have to move on now. Let's reconcile the NCI, or let's find the changes in working capital items. Okay, or let's do the NCI first. Okay, so let's reconcile the NCI. Okay, so since we have the NCI figure, let's reconcile the NCI. Okay, let's come to the non-controlling interest. Okay, so you ask yourself, the NCA for 2020, that the addition to the NCA for 2020 is 450. But what is the balance for our NCI? You look for your opening balance for the NCI. That will be okay. The opening balance for the NCI will be taken from our 2019 statement of financial position, because this subsidiary was not there in 2019. What was our NCI figure? We don't have any NCI, isn't it? 2019. There was no controlling interest. Is that the case?
Yes, there's none.
So if there should be a figure, you bring it and add the new one to it. So there's no NCI figure there. So we just look at fair value for these people, fair value at acquisition for the XM. That will be 450. Okay. What will increase the NCI? It is a share of what? The post-acquisition profit, isn't it? Okay. So the share of the post-acquisition profit, you go to statement of profit or loss and take that. What is the NCA share?
500.
Okay. NCA share will be 500. Okay. So what's supposed to be our NCA figure?
950.
Please, they have already charged the goodwill. They have already charged the goodwill to statement of profit or loss. You can see that this share over here is from statement of profit or loss. So goodwill already has been taken away from that. This share is not from the net asset table, no. So they have already charged this one. But what is the closing figure that they are giving for the NCI? Closing balance in the 2020 financial statement. Let's go to that year and pick our NCI figure there. What is the figure given to us?
650.
650.
Okay, so you have been given 650. So the question is, what is the reduction there?
300.
Okay.
200.
That reduction will be dividend paid to the NCI. So that will be 300. Okay. We have paid a dividend to NCI. NCI is also treated as investment in associates because their portion is having only significant influence. So today, know that NCI is treated as if it's investment in associates because their percentage holding 25%. That is a significant influence. So if you pay the dividend will be paid out of profit. So we'll be having 950 in the statement of changes in equity, but we'll be taking a dividend that we have paid by, or the dividend has been paid by the subsidiary. So we take that from the NCI figure and have that particular one. So you go to financing activities. NCI are also owners of the company. So you have to write dividend paid to the NCI here. So dividend paid to NCI here to be 300. That will be an outflow. Okay, so you move on. Let's now reconcile so you just be reconciling them one by one. So we come and reconcile the PPE and also the working capital items, but let's reconcile the investment in associates. Let's reconcile the investment in associates first. Okay, so the cash flow is all about reconciliation. Okay, let's reconcile the investment in associates. So investments in associates. Investments in associates. Okay, so you look for the opening balance. What is the balance for the investment in associates? What is the balance? What's supposed to be the balance? The opening balance, 2019.
9,000.
Okay, so we have the balance go down to be 9,000. Please, what we are doing is that we are trying to determine how the closing balance has been. The closing balance for the current year has been determined. Okay, they have done the correct thing already. So they will have the opening balance, maybe what the transaction that happened during the year, they will add it, then they will subtract some cash transactions there. So we are looking for the cash transaction that happened. So we want to determine how the closing balance for the current year has been determined. So we'll be having 9,000. So you go to your share of associate profits. Your share of associate profits. What is the share of the associate profits?
2,900.
2,900.
So what will be the impact of the share of associate profits on our investment in associate? Increase or decrease?
Decrease.
To decrease it.
Decrease or increase?
To decrease it.
Decrease or increase? If you have investment in
Increase.
bank and they are
Increase.
it's increase.
Increase.
You have an investment that they are paying you, they are declaring a profit and you are having your share. That is the profit is an income for you. So it will be increasing this one. You debit your investment and credit your retained earnings. So that will be 2,900. Okay. What is the closing balance given to us? So you go to your statement of financial position. What is the closing balance?
11,000.
7,000.
Okay. So your closing balance is 11,000. But what's supposed to be your balance in the investment in associates? What's supposed to be the balance? Supposed to be 11,900.
11,900.
Okay.
Yes.
So why is it now 11,000? You have received a dividend. Okay. If nothing has been said, it will be the dividend received, which is paid out of profit. So you have received a dividend. You have received 900 out of your profit as dividends. Okay. So the difference, if nothing is being said, the difference is treated as dividends. It can also be impairment in the associate, but if nothing is being said, it is dividend from the associate. This is an investment that we are doing. So you bring the dividend to investing activities as investments in, so dividend received from associates. So you bring that as a figure here. That is 900. That is a cash that you have received. So that is an inflow. Okay. So we are done with the associate also now. If you like, you can also reconcile your share capital. You can also reconcile your retained earnings before you move on to your PP, your inventories, and your receivables, and also your payables. So which one should we do first? Should we reconcile the share capital first?
Yeah.
The share capital, you have to reconcile the retained earnings first. There can be a bonus issue. So let's reconcile the retained earnings first before we go to the share capital. So the share capital, there can be a bonus issue that will be made during the year. And the question will actually tell you whether there is a bonus issue, but you can also determine that based on the increments. If the decrease in the retained earnings is the same as the increment in the share capital, then that is a bonus issue. Okay, so let's reconcile our group retained earnings. Okay, so we are only interested in how the closing balance has been gotten. So the closing balance will be calculated as the opening balance, which is 2019 balance. So let's go to 2019 balance for the retained earnings, 14,300. So we will be having 14,300. What will increase the group retained earnings? What will increase the group retained earnings?
Yeah, share of profit. I mean, post-acquisition profit.
So they are post-acquisition profits. So post-acquisition profit. The post-acquisition profit, the one given in the statement of profit or loss, is for both the parent share and also is for a share of the parent's profit from the associate and also together with the parent profit made for the year. So that will be 6,200. Okay. Let's add. What are we having from that side? So if you add 14,300,
20,500.
20,500. Okay. Let's go now to the closing balance that we are having. What is the closing balance for what is the closing balance for the retained?
18,350.
So what is the difference there?
2,150.
Okay, that 2,150 represent what?
Mm.
What decreases our retained earnings? What is going to be causing a decrease in the retained earnings? If you are preparing a final account, you have the opening retained earnings, you add profit. What is the next thing that you subtract?
Dividend paid.
Yeah, dividend. So dividends paid by the parents, dividend paid by the parents is 2150. So we'll be having our 18,350. Is it 18,350 or?
Yeah, that's it, 18,350.
Okay. So there was a dividend has been paid. Dividend has been paid. So this dividend paid is a subsidiary, which is paid to the NCI. So you can say dividend paid to NCI. So let me just write NCI here. So the subsidiary has paid a dividend and the parent has also paid a dividend to its owners. Okay. So dividend paid by the parents. It is very important to show them separately. Okay. So this will be the parent company. And that will be 2150. So we are done with the retained earnings also. That is the only thing. So the retained earnings, the opening balance plus the profits, any adjustment, finance costs, all those things have been adjusted already. This is profit or loss. So they have done all the post-acquisition adjustments in the profit or loss. So you just take that 6,200, add it, the difference will be a dividend paid, or the difference might be a bonus issue. We are changing the results to what? To the equity shares. Let's now reconcile our equity capital before we move on. Okay, what is our equity capital? How did they get the 35,000? That is what we are coming to look for. So it will be the opening balance. We have the equity capital, the opening balance. So let's have the equity capital. How would that be calculated? So we have the equity capital. They have the balance brought down. Okay, of how much is the balance brought down? 20,000. That will be 20,000. Okay. So what happened during the year? Were there any new issue of shares? What happened during the year? Okay, the acquisition was through what? So we are paying cash and share exchange. So what is the portion of the share exchange? 4,000 multiplied by 1.5. I'm sure that will be 6,000. Okay, so there was a share exchange. The share exchange will be increasing. So share exchange will be increasing our equity capital, which is not cash. So that was a share exchange of 6,000. Okay, so the closing figure, this is how we have our opening balance of the equity capital. We add our share exchange. That's how we consolidate. Okay, let's come to the closing balance given to us now. This is the only thing that is going to be increasing our share capital. This is supposed to be our share capital. Okay, what is the closing balance given to us? The closing balance is 35,000. Okay, so you have your 35,000 here. Okay, your supposed equity capital is supposed to be 20,000 opening balance plus the share exchange. Whenever there is a share exchange, we add it to the parent what? Share capital. So that's supposed to be 26,000. Now they are giving you 35,000. What is the increment there?
9,000.
Okay, so that will be issue of new shares. So there will be an issue of new shares. That will be 9,000. Okay, so if you issue new shares during the year, cash is coming in. So you come to your financing activities, you come to issue of new shares. So we have the issue of new shares. Okay, so additional issue of shares, that will give us 9,000. So we move on. Let's now reconcile our long-term debt before we go to our payables. So we also have income tax over here. We reconcile that also and know our tax that has been paid. So let's have the long-term borrowings. So let's come to the long-term borrowings. Let's reconcile that. Long-term borrowings. So we have 6 over here. So we have long-term borrowings. Okay, so let's have our figure here and reconcile. So we have the balance go down. Okay, the balance go down. So what is the balance go down for the long-term borrowing?
$42,000.
Okay, so we have 42,000. Okay, please, since there is no interest expense always in the statement, it means that they are accounting for the long-term borrowing as a financial asset. Where we add our interest to the principal, then we now subtract the amount that we are paying for the year. But if there should be interest as owings in the statement of financial position, we now account for the interest as a separate item, and also the long-term borrowing as a separate item. Okay, so let's come to this particular one. Okay, what is our finance cost from this place? What is the finance cost?
1,009.
Okay, So finance cost is 1,009. So this will increase by the interest. So we have finance cost of 1,009. Okay. So let's come to, they will always give you a footnote about that. Let's come to that and see. Okay. Let's say D, finance cost relates solely to the long-term borrowing. The effective interest rate of 4.52 was charged on the opening balance of the liability, and interest of 1,200 was paid in December 2022 together with the capital repayment. Together with the capital repayment. So the effective interest rate was 4.52, was charged on the opening balance of the liability, and the interest of 1,200 was paid in December together with the capital payment. So what is the portion of the interest that we are paying? How much has been paid for the interest? So out of the 1,900, how much was paid?
1,200.
Okay. So we are paying 1,200. So if you go to the finance cost or the interest paid under the interest, they are saying that if you use it as financing activities and if you treat as financing activities or operating activities, it's better, but they accept the operating expenses one because it's something that you are going to be paying out of profit. So you can treat it like that. But if you bring it to financing activities too, there's no problem. The interest is paid on what? On a financing item. So there's no problem. But for those ones, the interest mostly we treat it under the operating activities. Okay, so let's come to this particular one. Okay, so let's look at the supposed closing balance. What's supposed to be the closing balance?
43,900.
Okay, but let's go to the statement of financial position and get the figure that we are having there. What is the figure? What is the closing balance that we are having there? Okay, what is the closing balance we are having there? We're having 36,000.
Hello, sir.
Yes, please.
So it means the interest in the trial balance
No, that is
as a
statement.
result of the effective interest rate of 4 point.
Yeah, it is the same thing there. So you can calculate and see. You'll be getting the same figure, 1,900.
0.08. Okay. Okay.
So if you calculate it on I'm sure if you calculate it on the closing figure, you still be getting the opening figure, you still be getting that. So 42,000. Yeah, you get 1,900.08. Okay.
Thank you, sir.
All right. All right. So let's go to the closing figure that they are giving to us as the long-term borrowers. What is the closing figure? 36,000. So what is the difference there? It's supposed to be 43,900, but we are having 36,000. So what is the difference?
7,900.
7,900. So this is the amount paid. Okay, but this amount paid, you have to now separate it. Okay, this amount paid, interest payment is 1,200. So interest paid is 1,200. Okay, so what will be the principal that will be paid? Principal paid is what?
6,700.
Okay, 6,700. So the 6,700 will be treated as redemption of loan. So that will be, so we count to redemption of loan. And that is the cash that we are paying for that. That will be 6,700 as an outflow under the financing activities. So the interest paid, we bring it over here later, but for here, over here, I can now look at the changes in working capital items. So we go and now do the changes in working capital items. So changes in working capital items. So since we are done with the other ones, we can now focus on the changes in working capital items and also investment in PPE. So let's reconcile the PPE first. So let's look at the PPE. Let's look at property, plants, and equipment. So the property, plants, and equipment, how was the closing balance determined? Okay, they have taken the opening balance of how much? What is the opening balance of PPE?
32,000.
Okay, so we have the balance brought down to be 32,000. Okay, what will happen? We add the what? Acquisition, which is what? SM. Because we acquired the SM during the year, we are going to be consolidating its figure together with the parent figure. So let's go and look for the PP for them. So what is the PP that we are receiving from the associate? What is the value of the associate? I say associate. The subsidiary is what? PP. It will be added to the parent opening balance. Then we have the closing balance. So how much is their PP? 2,400. 400. Okay. What is going to be reducing our PP? Okay. We have a
Disposal.
depreciation.
Disposal.
Okay.
Depreciation.
Okay. There's no disposal during the year. The question has stated that there's no disposal of PP during the year. So there were no disposal for property, plant, and equipment in the year. But what is the depreciation figure?
4,000.
Okay. So depreciation will be reducing this. What is our supposed PP figure? There is no revaluation also, so there is no going to be any increment there. If there's a revaluation, you come and add a revaluation surplus to your PP. It will increase the PP figure. So I'm getting 3,400.
Yes,
Yeah.
please.
Okay, that's supposed to be our closing balance. But how much is the closing balance given to us? Okay, so the closing balance is 38,000. So it means that we have acquired what? So there is additions of the PP by how much? That will be 38,000 minus 3,400.
7,600.
7,600. So you now have your 38,000 as a closing balance. So it means that we have acquired additional PP during the year. So acquisition of PPEs or acquisition of non-current assets. So you have done workings, you can just put the workings number there. So that will give us 7,600. That is an outflow, 7,600. So let's now focus on the working capital items now. So we are done with property, goodwill, investments. We are done with the retained earnings, the share capital. We have now, okay, the income tax, we come to the income tax. Let's go to the income tax. But the income tax, we will do that after the changes in the working capital items. So, but let's reconcile the income tax before the working capital items. We know that the interest and those ones, interest is 1,200 and the income tax will also be how much? So let's do the income tax here. Please, the income tax, if you have deferred tax, you adjust the two as one. Okay, because deferred tax, movement in deferred tax will always be adjusted against the income tax. So you can have income tax balance, opening balance, deferred tax, opening balance, add the two. So what is the tax for the year? You bring that one to an addition. Then you now determine the closing balance also. Add the income tax and deferred tax closing balance and compare with the supposed balance. So currently we say that we are owing the tax authority how much? How much are we owing them? What will be the opening balance at the start of this year? income tax?
200.
That will be 3,200. Okay. So that will be 3,200. Okay. How much are we saying that we are owing them for this year? What will be the owings for this year? We go to our statement of profit or loss. So we are owing them 3,200 for the previous year, and we are still owing them 2,500 for this year. So what's supposed to be the total owings? So we go and add the 2,500 to that. That will be the tax expense for the year. So the amount that we're supposed to be owing them supposed to be how much?
5,700.
5,700, isn't it? Okay.
Mm.
So you now go to the statement and see what figure are they reporting as the owings for the income tax. What is the owings for the income tax?
4,000.
4,000. So it means that we have paid an amount of that. So we have the tax paid. So let's come to the tax paid or the cash paid. You can just write it anyhow. That will be 1,700. Then we have our closing balance of 4,000. This will be adjusted in the operating one, but this will be after we are done with the changes in working capital items. So let's come to the
Hello, Leonard.
yes, yeah.
So in the case where the closing balance has increased, and then the difference, what will be the classification of the difference?
That is a tax credit.
Maybe a new accrual or something.
No, that is tax. If the closing balance is higher than the supposed figure, if the closing balance is higher than the supposed figure, no, that cannot actually be. If the closing balance is higher than the supposed figure, then maybe there is additional owings again. So that will not have any effect on our cash flow. Okay. That will not have any effect on the cash flow because they have done the correct thing. Everything that is given to you over there, it means that the company has correctly accounted for all the items. So that cannot actually, if that is the case, it must be reflected in the closing balance. If there are additional owings, it must be reflected in the closing balance because they have taken all those things into consideration. Okay. We can also have the difference being a tax credit. The 1,700 over there, it can be a tax credit, but since nothing has been said about it, you take it as tax paid. Okay, but if they say it's a tax credit, that particular tax credit is not going to be, the GRA will not give you money for the tax credit. They'll just take it from your tax that you are going to be paying. So that tax credit, maybe it might be included in receivables. We have to go and adjust that in our receivables. So let's come to working capital items now. Working capital items. Okay. So the working capital items, you have your, so you can have your inventory here. So we just put all of them together. We have our receivables here. So let me just write the receivables very well. Receivables. And we have our payables. Okay. So let's have the currency sign, and currency sign. Okay. So this one, our work over here is that we want to know how the current figures has been ascertained. So how did they get the 28,000? Okay. They have the 26,000, which is the opening balance. They will add the subsidiaries owned to it. So we have the balance go down for inventory of 26,000. What is the opening balance for the receivables? Okay, that will be 25,000. 25,000. What about the payables? The opening balance?
1,500.
Payables is 14,000. Cash will be adjusted. It's just like opening balance plus the cash will be all the cash that we received during the year, we add it to the opening balance of the cash. So we don't actually adjust the cash. Okay. So this will be 14,000. Okay. This is for the parent before the acquisition of the new subsidiary. So you bring the SM figures here. Okay, this has been done during the year. So this will be included in the current year figures. So let's go to the subsidiaries net asset. Inventory for them is how much?
3,600.
3,600.
So we have the 3,600. I'm sure receivables is 2,000
2,000.
and the payables is 3,800, isn't it?
Yeah.
Okay. Were there any income tax for these people? No. Okay. So if there should be income tax over here, then that will be adjusted against our income tax before we know the tax paid, because their income tax expense will be added to our opening balance. So you have to adjust that. There is nothing over here. Okay. The question can also tell you that a subsidiary has been disposed of during the year. If a subsidiary has been disposed of during the year, it means that the subsidiary has been there since. The question will say that, okay, the company has acquired a subsidiary for some years or some years ago. It means that the subsidiary that we are disposing, their inventory, PPE, and their payables figures are included in the opening balances. They are part of the opening balances. If you are now disposing them, it means that you are going to be removing their values from what? From the financial statement. So we bring the disposal over here and what? And subtract. But this case, there is no disposal. It's just about acquisition. So let's look for our suppose. So if there's a disposal, we subtract. So since there's no disposal, let's look at our suppose what? Balances. So we have 26,000 plus 3,600. I'm having 29,600. So this will be 27,000.
Sir,
Yes, please.
sir,
I can hear you, Senior.
sir.
I can hear you, Senior.
Yes, sir. So based on what you just said right now, that the subsidiary had been disposed of, we have to take off the inventory and whatever. What
Yeah.
about the property, plant and equipment?
Yeah, I've mentioned that one too.
I'm sorry, I didn't hear.
Okay, so they are also going to having PPE. So the PPE have to be taken off. Their non-controlling interests also have to be taken off. You have to remove all the necessary things. If they have a goodwill, the goodwill will also be taken off. Okay. So let's come to, I'm having 17,800 here. So you come to their closing balances. So what is the closing balances in the statement of financial position? What is their balances there? So inventory is 28,000. So inventory is 28,000. Okay. Receivables is how much?
22,000.
Okay, 22,000. 22,000. Okay. Then payables is how much?
20,000.
20,000. So let's look for the differences now. Okay. The difference for the receivable, the inventory is how much?
1,600.
1,600. 1,600.
1,600. So the opening balance was higher than the closing balance. That is going to be increasing our okay. So we have the receivables will be how much?
5,000.
5,000. So that is a reduction of 5,000. So this will all be a reduction. Okay.
$2,200.
2,200.
200.
Okay, that will be addition of 2,200. Okay, so our opening balance for inventory is higher than the closing balance. If the opening balance is higher, that is going to be reducing our cash because it will be having impact on our what? On our profit. So the profit will be reducing. So our cash component will be reducing. So you come to the changes in working capital items. You look at the okay, so let's come here. We have the decrease. Okay, that will be a decrease in the inventory. So let's have the decrease there. So this, the decrease in inventory will be treated as outflow. Why is it outflow? Because the opening balance was higher than the closing balance. So if opening balance, we are using the opening balance is higher than the closing balance, that particular increase over there will be increasing the cost of sales, which will be reducing our profit. So our cash components has reduced by 1,600. Let's go and add it back. Okay, so let's come to the other one too, which is the receivables. Okay, what will be the receivables also? The receivables also is a decrease. Okay, receivables is a decrease in receivables. Decrease in receivables. Okay, decrease in receivables. Decrease in receivables. Okay, so our opening receivables was higher than the closing balance. What is the impact of the opening receivables on our revenue? It is going to be reducing the revenue because the opening receivables will be subtracted from the cash receipt. So it means that it has reduced our cash that we have received because the revenue has been calculated as the cash receipt less the opening receivables add the closing receivables. So since the opening receivables is higher than the closing receivables, it is automatically going to be reducing our cash component that we have received from the debtors. So that will also be added back to neutralize the increase in the receivables there. So let's come to the payables. Okay, let's come to the payables. So the payables also, our closing balance is higher than our opening balance. We are using credit purchases. Okay, how do we determine the credit purchases? Is the cash paid less your opening balance, add your closing balance. So it means that our closing receivables will automatically increase our purchases by the difference, which is 2,200. Our cash paid has increased by 2,200. Okay, it's just like this. The cash that you paid to your suppliers is, let's say, is 20,000. Okay, it's 20,000. But your amount that the cash paid, the amount that you are owing them. So owings, that is the opening balance. Okay, you have paid, you are owing me 17,800. You have paid 20,000. It means I will first take the amount that you are owing me, and the remaining balance I will sell. I'll give you an item equivalent to the remaining balance. But after everything, you are still owing me 20,000. So if you are still owing me 20,000, then it means that the total thing that I've sold to you right now is the 20,000 plus the cash that you are paying. So you have the 20,000 here. Okay. So what will be the figure that I'm reporting as the purchases? 20,000 minus 17,800 plus 20,000. I'm reporting 22,200. Okay, is that correct? This will be the purchases for the year. But we are looking for the cash paid. The cash paid is 20,000. Okay, but our purchases that we have used to get a profit is 22,000. Okay, our purchases that we have used is 22,000. Okay, so what is happening now? It means that our purchases has what? has been increased by 22,200. So what we have to do is that if we know the purchases, we have to go and take the 2,200 from this one. Okay. So since we don't have this figure, we know that this effect on the cash is that it reduces the cash by 2,200. So you go and add your what? Your increase in purchases, which is going to be, so increase in payables has increased our purchases figure. So that will now be added to now neutralize the effect. So add it to the profit because that has reduced the profit. So add it and you have your figure there. So let's put these figures together and get our items there. So 20,200. Yes. Okay. So 20,200 plus 5,000 plus 1,600 plus 4,400 plus 1,900 minus 2,900. I'm getting 12,200. Is that correct? All of these ones, all these adjustments. Okay. So plus 9,200, what are we having? 21,400. Okay. Then we now come to the interest paid and then the tax paid. That will be adjusted. So interest paid was 1,200. That will be an outflow. The income tax or the tax paid. So we have done that already. I'm sure that is 1,700. Let's go and check. Okay, tax paid is 1,700. The interest paid. Okay. So what will be our 1,200 plus 17,000 plus 7,000? I'm having an outflow of 2,100. What will be the balance? I'm having 18,500. So we have the net cash flow from operating activities. Okay, let's come to our investing activities. What will be the cash flow there? 150 plus 7,600 minus 900. I'm having 6,850 as the net inflow. So we have the net cash flow from investing activities. Okay, so equal to financing activities. What will be our figure for the financing activities? So 6,700 plus 2,150 plus 300 minus 9,000. Okay, so I'm having negative 150 as the net cash flow from financing activities. Okay, so let's put the two together and have our net cash flow for the year. Okay, for the year. So let's put them together. We have the 18,500. Okay, against 6,850 minus 150. I'm having 11,500. Is that correct? So our net cash flow for the year will be the cash flow from operating activities, add your investing activities, and add your financing activities. So I'm having 11,500. This is the cash that we have received from the year. So we add our, so this is the cash receipt. This will increase our opening cash. So we'll add cash and cash equivalents. Add cash and cash equivalents at the start. So how much is that? This is the amount that we are receiving for the year, and our cash balance at the start is what?
1,500.
That's 1,500.
So 1,500. So you add 1,500 to this one, and you'll be getting your closing balance. If you are not getting your closing balance, please forget it and move on. Okay. It's 20 marks out of the 80 marks. No, nobody's going to look for you. You are not even using your name. So nobody's going to look for you and give you an award for doing the cash flow statement very well. No. They will only publish the names of those people who have passed the exam, and you will not be passed because you have wasted your time on things that you haven't. No, just go and do the reconciliation. The reconciliation will give you most of the ticks done, whatever you are going to be presenting there. Although they are also going to be giving you ticks, but you cannot bring these figures without what? Without doing the reconciliation. So you can see that the reconciliation will give you more marks than the other one. You just have to know wherever there is an increase in the working capital items, how is the treatment? Okay, you can go by your own. If the inventory is reducing, it means that we have sold inventory during the year. So that is cash is coming in. That is what we all know. Okay, that was the song that we have been singing. So if the inventory is reducing, it means that, okay, we have sold 1,600 during the year. It means that, no, that is a lie. Okay, you have not sold anything. It's just the impact of that on your cash flow that you are looking for. Okay, but if that will work for you, no problem. If you are receiving it, if the receivable is reducing, it means that you have received cash from the customers. If the payables is increasing, what does it mean? What are you going to be giving to the payables now? Is it that you are borrowing more money from them, so cash is coming in? No. Okay, but if that will be the thing that will work for you, if that is the song that you can use to know the adjustment, for me, I don't have any problem, but that is a lie. It is not you are selling or you are receiving money. No, it is the impact of the closing and then the opening balance on the cash receipts that you have to show in your cash book. All right, so this is all about this question. We will solve additional question tomorrow, and we also touch on a foreign subsidiary. So a company might be in Ghana and they might acquire a majority of the shareholding in a company located in Nigeria. The parent has to prepare a consolidated financial statement. But these are going to be having two presentation currencies. How do we go about it? Yes, so it's not anything. So this is the first side of the cash flow statement. We pick a question where we be having acquisition and disposal. So how do we go about it? And that is what we are going to be solving tomorrow. And we touch on accounting for foreign subsidiary. Then we know that we are done with the diet. We come back and do the revision from Wednesday done. Any question? All right. So in the absence of
Sir, please, I think I joined late, so I'm pleading if the video can be made available so that I can follow from the beginning.
No problem, sir. But right now, it seems like the Vodafone is not good at Adon, so I'm using MTN. So as soon as the video is converted, I'll make it available for you. Thank you, sir. All right.
Okay, thank you.
Thank you, sir.
All right.